Everyone has an opinion about Realty Income. Some say it's the safest REIT on the planet, others say it's dead money. So here's the real question: who's right? Today we'll look at the data and settle this debate once and for all. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term, triple net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. The company is currently available with a 5.72% starting dividend yield compared to its 5-year average of 5.04%. The price-to-AFFO ratio is now 13, while the 5-year average was 14.9, and the sector average is around 14.8. The stock is trading at about $56, whereas the expected price is estimated to be between $58 and $71. Based on these metrics, the company appears to be slightly undervalued. The company currently pays $3.24 in dividends per year, distributed monthly in 12 installments. The next dividend payment will be on December 15th, and anyone who holds shares by November 28th at the latest will be eligible to receive it. The most recent dividend increase was 2.9%. The average increase over the past 5 years is also 2.9%, while the 10-year average was 3.6%. The FFO payout ratio is well below the healthy 90% threshold and has been showing a strong downward trend. FFO per share, on the other hand, is on a steady upward trajectory. The growth isn't very fast, but it is stable, and the company even managed to grow during COVID and continued to perform well in today's high interest rate environment. The company issues new shares every year, which is completely normal for REITs. These issuances typically fund expansions, renovations, and dividend payments. As long as the total sales chart grows at least as fast as the shares outstanding chart, this does not pose a problem, and that condition is being met here. The company did take on a bit more debt than ideal during COVID, but management took this seriously and began reducing leverage. Based on expectations, the company could once again fall below the 5.5 leverage target within the next 12 months. Meanwhile, the interest coverage chart has remained comfortably above the 2-point threshold for the past 10 years. In short, the company is currently available with a nearly 6% starting dividend yield, with the most recent dividend increase around 3%. It holds an A- credit rating, and the dividend appears to be safe. Based on the overall fundamentals, the company may be slightly undervalued and could be an attractive entry point for more conservative dividend investors. The fact that it pays dividends monthly is an additional bonus.
Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video.
When you look at Realty Income's latest quarter, the first thing that stands out is how consistent the company continues to be. Even in a higher rate environment, they deployed $1.4 billion in new investments, including $1 billion in Europe at an 8% yield, while U.S. investments came in at a 7% yield. Sourced volume has already reached $97 billion year to date, surpassing last year's record. Operationally, the quarter was extremely strong. Occupancy reached 98.7%, and the 103.5% rent recapture rate across 284 released properties shows that not only are tenants staying, but renewed leases are being signed at even stronger economics. Financial flexibility remains solid as well. Realty Income ended Q3 with 5.4 times net debt to EBITDA and a 4.6 times fixed charge coverage ratio. After the quarter ended, they added approximately $1 billion in unsettled forward equity and issued $800 million in unsecured notes at a 4.4% yield, further strengthening their liquidity position. Management reaffirmed their AFFO per share guidance of $4.25 to $4.27 and raised their investment volume outlook to $5.5 billion for 2025. This increase signals confidence in sourcing attractive opportunities despite a challenging environment. Looking beyond the quarter, Realty Income's long-term portfolio stability continues to differentiate the company. Their occupancy levels have held around 98% plus for decades, including during recessions and shocks, far above the median REIT. Credit losses remain exceptionally low, averaging just 0.4% between 2014 and 2024. This reflects high-quality tenants, disciplined underwriting, and strong asset management across a massive global portfolio. Europe continues to be a major growth driver. Since 2019, Realty Income has invested nearly $15 billion across 8 countries, with an average remaining lease term of approximately 8.3 years and strong rental economics. Management believes Europe offers a larger total addressable market than the US, supported by lower competition and more favorable debt costs. Across the entire portfolio, Realty Income's global diversification by tenant, geography, property type, and industry remains one of its greatest strengths. These slides demonstrate how size, scale, and geographic breadth contribute to unparalleled cash flow durability. Realty Income's predictability remains unmatched. High occupancy, strong recapture, minimal bad debt, and continued global expansion, including Europe. The balance sheet is also robust, supported by strong credit metrics. The main challenge is the higher cost of capital, which tightens acquisition spreads. Only 4% of sourced volume has been acquired in 2025 year to date, highlighting tougher deal economics. General and administrative costs are slightly elevated, and 5.4 times leverage, while safe, is on the higher side of Realty Income's historical range. This quarter reinforced everything Realty Income is known for: stability, disciplined growth, and strong global diversification. With high occupancy, reliable cash flows, and steady AFFO performance, the company remains one of the most dependable income-producing REITs. Despite headwinds from interest rates, Realty Income's long-term fundamentals, scale, conservative underwriting, and mission-critical real estate remain firmly intact.
Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.